What's next for markets and the global economy after a year defined by escalating tariffs, persistent geopolitical tensions, and the rise of artificial intelligence across industries?
We see a constructive outlook across most markets, with both DM and EM equities expected to beat other assets, in particular cash and bonds.
We're seeing growth forecasts getting upgraded across the curve as we're going into the new year, and there's a lot of fiscal and monetary policy easing that is going to provide a tailwind for an improving growth backdrop.
We do believe sticky inflation overall remains a theme on the global stage, and it is, I think, an important in terms of limiting the ability of central banks overall to lower interest rates.
Welcome to JP Morgan's Making Sense. I'm Sam Azzarello, and I lead content strategy for global research here at JP Morgan. Today, I'm joined by a few of my colleagues to discuss our outlook for 2026. To kick things off, we'll hear from Bruce Kasman, our chief global economist. Bruce, thanks so much for being here today.
Thanks, Sam, for having me.
So, Bruce, what surprised you most about the global economy in 2025?
I think the biggest surprise was the resilience of the global economy in the face of some significant negative shocks. The particularly big one was the rise in U.S. tariffs, the trade war that had opened up. But at the same time, I think the resilience of the global economy has not come with balanced growth. And there was another surprise, which was the divergence in a global economy, which seemed propelled by strong CapEx and particularly tech spending in 25, and at the same time had a fairly sharp slowing in job growth. That juxtaposition of CapEx accelerating and job growth stalling for the most part was a major surprise.
Fantastic. Thanks for that, Bruce. Where do you think the global economy is headed in 2026, and what are the key factors to watch?
So the global economy's movement into 2026 to us is being driven by two broad factors. One is the sense that the sentiment shock that came this year in 2025 alongside the trade war begins to fade. And we think that will be an important catalyst for recoupling the labor market to the overall picture on growth. Labor markets have been quite weak. Job growth has nearly stalled across the major economies. And if we're right, we get a lift from fading of some of the concerns about policy, a lift that's partly supported by the easing we've seen in monetary and prospective easing in fiscal policies. And we therefore get, as we move through 2026, an alignment of solid growth with more normal performance in terms of job growth rebounding. That's the first thing I would emphasize. The second thing we would look for is less synchronized, but still overall sticky inflation in that environment. That's partly driven by the continued overall environment of goods price pressures being different than that they were before the pandemic. And it's also being emphasized by the fact that as job growth recovers here, we continue to see weak labor supply dynamics, immigration policies having shifted materially across most advanced economies. And with that, we begin to start to see a turn again towards labor market tightening, which basically shifts from what has been some softening we've seen in the US and other countries this year. So sticky inflation, weak supply sides due to immigration policy, and solid growth as you recouple the labor markets to an overall decent performance we're expecting across most of the globe. One of the consequences of this, of course, is that central banks do not get the opportunity to validate market expectations for interest rate declines, and we are not looking for much, if any, additional easing from most central banks, with the exception of the high-yielding EM central banks that probably still have more to come.
Final question for you. Will sticky inflation remain a prevailing theme next year?
We do believe sticky inflation overall remains a theme on the global stage, and it is, I think, an important in terms of limiting the ability of central banks overall to lower interest rates. What I would also suggest, however, is we're moving away from a period in which inflation dynamics are more synchronized. That was clearly a factor in the post-COVID Russian invasion environment in which these global shocks were so important. Inflation dynamics are going to be more driven by local conditions, particularly labor market tightness. We do expect overall here to be relatively sticky and stable inflation, but also expect to see more variation, with perhaps the most notable variation is that we have inflation in Western Europe coming down to target and inflation in the US staying close to 3%.
Bruce, thanks for your insights. Next up, we have Mislav Matejka, Head of Global Equity Strategy. Mislav, thanks so much for joining us today.
Hi, Sam. Thanks for having me.
So why don't you start by walking us through the overall outlook for global equities in 2026 across both developed markets and emerging markets?
We see a constructive outlook across most markets, with both DM and EM equities expected to beat other assets, in particular cash and bonds, with equities offering in the range of 10 to 25% upside in our view. And the bullish call is driven by the supportive growth policy trade-off, where on one hand, we look for robust earnings delivery next year, and that is underpinned by resilient activity momentum in the US, but also an improvement among laggard regions. So China here, it could show green shoots of consumer recovery, and Eurozone fiscal stimulus is likely to become much more impactful. And on the other side, inflation is likely to stay on the downtrend due to subdued Brent, slowing wage growth, and slowing services inflation, which in turn will keep Fed in particular dovish through the first half of 26. And the bond yields, therefore, are unlikely to break out higher, and especially not to break out higher for the wrong reasons. Now, more specifically for the US, we are looking for the rally that is supported by continued rapid AI rollout. And therefore, in the US, we keep preferences in terms of the styles for large caps and for the growth. In the rest of DM, we think that Eurozone will show better earnings delivery after 3 years of stalling, and that is on stronger activity and less headwinds from trade and from the FX. Japan was our key DM overweight call for 25, and we still think that it goes up further in 2026, but after the big rally, valuations are becoming fuller. And finally, within the EM, which we like, we in particular have bullish calls on Korea, India, and on Brazil.
All right, certainly a lot for us to keep our eyes on. How is the relentless expansion of AI fueling record CapEx and earnings expansion? And how might this impact markets in 2026?
AI rollout remains a clear positive for markets, focused on the US, given that almost half of S&P 500 weight is AI-related these days. Now, the rapid AI capex is set to continue, and that's almost irrespective of whether stocks keep performing, as in a sense, this is seen to be a US versus China race, and one can't lose. And within the US, there is a winner-takes-all mentality. So capex projections are only likely to get higher without anybody being able to step off, even if the stock prices don't follow. So the natural risk here is the one of commoditization, with returns on investments not delivering, of concentration risk, and eventually of overcapacity. And we are cognizant of these, but we do believe that AI rollout is in early stages, and that's really, if you kind of brand it, year 2 or 3 out of potentially 10 plus. In contrast, smartphones, they took 8 to 10 years. Cloud took 8 to 10 years of the accelerated adoption. So there is much more to go. Here, as we mentioned before, in the US portfolio, we are staying constructive on the AI theme and the overweight on large caps versus small caps, as well as the growth versus value style. Now, AI names have been responsible for pretty much all the incremental earnings growth in the past few years. And in our view, they're likely to deliver above market earnings growth again next year. Within this, as we move through 26, we do expect more and more companies to be able to point out the benefits of the implementation of AI tools in their operations, which would support their productivity and profit margins. So the AI trade should be broadening. It should be broadening into the adoption beneficiaries of AI. So the next 100 companies in S&P 500, and that will also be helping the international names.
Besides AI, What are some other key factors that could shape global equity markets in 2026?
For a long time, AI was the only story in town, and almost all the price returns, all the earnings, and all the capex in the past years were driven by AI. We do see additional sources of the upside for equities next year. In fact, for S&P 500 in the latest Q3 results, the remaining 493 stocks have recorded the best earnings growth in years at plus 12%. And the gap with Max 7 has narrowed quite a lot. That is healthy and will address to some extent the concentration risk that is in the markets. Also, Eurozone stimulus has not materialized really so far this year. And we feel that it was actually correct to fade the Eurozone rally from Q1. We have been arguing since March for a consolidation phase, as in our view, there wasn't likely to be much of an earnings follow-through, if at all. This worked, and we now expect that into next year, there will be more positive performance of the region, with earnings finally delivering on the upside. Besides these, trade headlines will be an important consideration, as into the midterms, US administration might want to water down some of the tariffs in order to ease the cost of living pressure on the US consumer. And Fed outlook, it would be also the key factor driving equities, where any potential turn towards more cautious stance could impact liquidity adversely. But also there is this wildcard of Fed potentially staying dovish if some of the inflation numbers do indeed move lower.
Mislav, thank you for sharing your views.
You're welcome, and nice talking to you.
Next, we'll look at rates with Francis Diamond, head of European rate strategy. Francis, thanks for being on the podcast.
Hi, Sam. Thanks for having me.
What's the overall outlook for rates markets in 2026? And are there any regions you'll be keeping a close eye on?
Yeah, well, I think, Sam, there are a variety of different themes for global rates markets for next year, based on our views around monetary policy and the macro outlook. And if we take the baseline view being one of resilient growth with a global recession likely avoided, and a generally broad disinflation backdrop with some increased divergence, that kind of sets the scene in terms of probably limiting the potential for yields to rally. But I do think that means, as a theme, we can look to seek carry opportunities in certain markets where central banks are in hold, particularly in the euro area and in Sweden. I think there is a bit of divergence across curves, which we'll look to investigate, particularly at the front end of the US curve, where rates look probably a little bit too low in our view against our macro backdrop. And we think the Fed is probably delivering slightly fewer cuts than markets are currently pricing. And maybe the conversation will slowly turn towards hikes at some point, but I don't really think that's a big story for next year. And that's probably more a 2027 theme that can start to kick in towards the back end of 2026. So I think this probably means there's a bit of a theme of cross-market divergence between US and Euro, which we'll be keeping an eye on. And we also keep an eye on potentially increased fiscal and political term premium in the UK, which might have an impact on intermediate yields from the second quarter of next year. And also the fiscal backdrop and issuance dynamics will be a focus for Japanese rate markets as well.
Very interesting insights. Do you see monetary policy continuing to diverge across the globe next year?
Yes, for sure. I think there's definitely scope for some divergence across the DM central banks. It's probably limited in nature, but certainly there's probably the Bank of Japan expected to be the only DM bank that's tightening. We expect the policy rate to rise to 1% by the end of next year as underlying inflation continues to rise. We think the easing cycle for many central banks, though, has ended. So we see the ECB, the Riksbank, the Norges the RBA and the RBNZ all on hold over 2026. I don't think it's only the Fed and BOE are expected to ease a little more. We forecast one further 25 basis point cut from the Fed in January, which is a bit less than what's priced into the front end of the curve in terms of the terminal rate over 2026. So we see terminal rate getting close to or getting to 3.5%. And we expect the Bank of England to cut rates to about 3.5% by the middle of next year, which is a little more than priced into markets. So definitely some divergence, but relatively limited compared to what we've seen over previous years.
And final question for you, Francis. What's the forecast for yields? Are they expected to grind higher over the course of 2026?
Well, again, I think it's somewhat selective here, Sam. So in our base case forecast, I think we do think 2-year Treasury yields can rise modestly over the second half of next year. But at the front end in Germany, yields are a lot more range bound. And probably at the front end of the UK, maybe yields are grinding a little bit lower, to be honest, in terms of a modest rally over the next few months. And if we look further out, we see 10-year bunds probably around about 275% by the end of next year, 10-year treasuries at 435% by the end of next year, and 10-year gilts around 475% at the end of next year. So that does imply modestly lower bund yields, whereas we do think 10-year gilts and 10-year treasury yields can grind modestly higher over 2026. I'd say when we think about the curves, that just gives a bit more of a mixed view in terms of how curves can behave across regions. So probably a bit of steepening in the UK, unchanged in Germany, some modest steepening in the US as well, and then flatter curves in Japan and Australia. And finally, when we just look at sovereign intra-EMU spreads, I think it's just a story of spreads moving sideways over the first half of next year, with maybe a slightly more cautious outlook over the second half of next year.
Francis, thank you for joining and sharing your insights.
Great. Thanks for having me, Sam.
Now let's hear from Meera Chandan, co-head of Global FX Strategy. Hi, Meera. Great to have you on the podcast. Looking ahead, what are the main forces shaping the FX market in 2026?
There are two main macro themes that we'd be focused on. The first is that central banks are going to be transitioning from what was a simultaneous easing cycle in 2025 to a simultaneous hold at relatively high levels above pre-COVID levels in 2026. So this is a pretty big transition where 70% of central banks were cutting rates, now no longer doing that, relatively inactive. The second pillar of the macro theme is that this is going to be a fairly pro-cyclical dynamic going on in the background. We're seeing growth forecasts getting upgraded across the curve as we're going into the new year. And there's a lot of fiscal and monetary policy easing that is going to provide a tailwind for an improving growth backdrop. So inactive central banks, strong growth. If it sounds like the middle of the dollar smile and a low volatility environment, that's exactly what it is.
So, Meera, is the US dollar likely to remain under pressure in the year ahead? And what are the main drivers behind your outlook?
Unfortunately, the prospects don't really look brighter for the dollar in the coming year. We have been bearish the dollar since March of 2025, and we continue to stay bearish as we look in the year ahead. The reason for that, firstly, is that at least in the early part of the year, the Fed will either keep rates unchanged for a long period of time, or they're going to cut a lot, either for data-driven reasons or perhaps if political pressures start to mount. But regardless, I think what that means is any kind of dollar strength we get is going to be quite bounded, whereas the dollar weakness could be more open on the downside. I think there could be long periods of dollar consolidating at relatively unchanged levels, because if US growth is 2% and it's yielding 3.5%, that's a pretty good outcome. But the risks on balance, if we do get a large move, I think is skewed to the downside.
Lastly, let's talk about other currencies. Which ones will you be watching closely and why?
The currencies to watch in 2026 are going to be the usual three major ones. I would say the euro, yen, and the Chinese yuan. Euro dollar, look, net, we are still bullish, but we have lowered our sights. Our previous target on the upside was 122. That we've taken down to 120. But I also think equally Eurodollar can spend long periods consolidating, because while Eurozone is on its own growth path on the fiscal front, the US is on its own growth path with AI and tech. So that can be offsetting factors from time to time. So we do think Eurodollar can consolidate 116 to 118 in the near term, get to 120 as global growth improves. I would say the floor on Eurodollar is around 115 if we do get a hawkish repricing for the Fed. On dollar yen, I think that's going to be an interesting one to watch early on in the year. The Takaichi administration has turned sharply towards reflationary policies that drove weakening in the yen in the first place. Now the global monetary policy easing cycles are coming to an end. Global growth is strong, so the use of yen as a funder should just accelerate. So we do think dollar yen will breach 160 in 2026 and yen risks remain skewed to the downside. Chinese yuan, not much movement there really. I mean, dollar CNH we think is going to be just above the 7 level. And what that means is the currency remains weak on a basket basis and retains its competitiveness. The Chinese economy retains its competitiveness versus the rest of the world. And what that means is it continues to be an anchor that prevents the rest of the Asian complex from strengthening too much. So those are the three currencies to watch.
Thanks, Meera. Really appreciate your views. And now for a look at credit markets. Stephen Dulake, our co-head of Global Fundamental Research, joins us. Steve, thanks for stopping by.
Oh, thank you for having me.
What's the overall picture for global credit markets in 2026?
In general, I would say okay-ish. I mean, optically, from a macro perspective, we expect this year's macro resilience to continue into next year, which is to say we expect continued economic growth. We expect inflation to moderate a little bit, but we do think, obviously, one potential fly in the ointment is the Fed's ability to cut rates further against the backdrop of a much firmer economic baseline than we were forecasting a little while back. I would say, though, that in many ways, as the year progresses, we think that the micro will sort of become increasingly relevant from a credit investor perspective. Specifically, we're expecting a notable pickup in net issuance, not least here in the US, obviously expecting continued supply from the AI ecosystem and the AI adjacent ecosystem. We're also expecting issuance related to M&A and LBO activity to pick up in both high grade and high yield. And we think all of those things take a little bit of a toll on spreads on a look forward basis. So from where we are today, we think spreads will widen a little bit, albeit a little more so in high grade relative to high yield. So we expect to see a little bit of compression in a modestly wider spread environment. We also expect returns in high grade to dominate those in high yield, and that reflects the impact of the much longer duration in the high grade market, given our rate strategist expectations that bond yields will rise a little bit through the course of 2027.
Steve, in light of everything you just mentioned, are there any risks we should be keeping a close tab on?
There are. I mean, I would say first and foremost, I would say risk-wise, any significant deviation from our macro baseline. So, to the extent that growth proves to be even firmer than we expect, that would have likely knock-ons in terms of sticky inflation at a time when affordability is already currently a bit of a hot political potato. So I think the market could get itself a little bit in a pickle against the backdrop of higher growth, because naturally the market would expect sticky inflation, naturally begin to bring forward a date at which they expect the Fed to raise rates. But we obviously know that in Washington, the executive is very clear in its desire to see lower rates both at the short end of the curve and at the long end of the curve. So I think that could inject some volatility and some more aggressive moves in bond yields. And that could be an environment where you see credit rates correlation go to one. So you have higher bond yields and higher credit spreads. The flip side of that, obviously, is a much weaker economic outturn. Let's call it something between decidedly subpar growth and recession. I think it's fair to say today that spreads really aren't pricing any material contingency of recession. So I would say in either direction, a material deviation from our macro baseline potentially poses risks for spreads. The other thing I'd probably talk a little bit about would be, to the extent there's a lot of focus on the increasing use of debt by the AO ecosystem to fund its capital expenditure plans. If the sort of monetization curve, so to speak, associated with those investments proves to be a little bit flatter than we all expect, which is to say the return on those investments takes longer to manifest itself, that can be an environment where markets begin to expect or anticipate much weaker balance sheets. So although we are talking about fairly high rated companies underlying this issuance, it doesn't mean that spreads couldn't widen a lot given the growing concentration in the market of the sort of AI ecosystem and adjacent sectors. So those would probably be the two main things I'd focus on.
Lastly, let's touch on spreads. Are credit spreads expected to widen next year? And if so, why?
So we touched on that a little bit already. We expect spreads to shift a bit on the back of increased issuance. So a relative rise in supply relative to demand. That's not to say we're expecting a material decline in demand, kind of given the prevailing yield structure, or all-in yield structure, I should say. But as I mentioned, we are expecting more supply, firstly from the AI-related ecosystem, and secondly, as a result of increasing M&A and LBO activity. I think that will result in an expectation we'll see some slippage in credit fundamentals. So those are the principal drivers for our forecast of moderate spread widening in 2026.
Fantastic. Thanks for that.
Thank you for having me.
Next, we'll hear from Johnny Goulden, head of emerging market fixed income strategy. Johnny, thanks for joining the podcast.
Thanks, Sam. Great to be here.
As we head into 2026, what does the macro picture for emerging markets look like?
So it's a good contrast if we think about where we are now versus where we were this time last year. This time last year, obviously looking into 25, the outlook was very uncertain and basically negative for emerging markets as the new US administration was going to change a lot of the macro settings. But as we look into 26, the macro backdrop looks less volatile and more supportive. So we are generally constructive on emerging markets, particularly local markets, FX, and high-yielding local bonds. If we think about growth first, actually, our economist forecasts are pretty similar to this year. So a view of continuity, I would say that maybe there's some upward bias given the AI capex cycle. There's been a lot of monetary easing, but the growth environment looks pretty supportive on emerging market inflation. This has been falling for 2.5 years. We are getting close to the end of that process. That means that EM central banks will not be able to cut as broadly as they have in the last few years. So we have to position for more differentiation around central banks in rate markets. Otherwise, EM debt dynamics for both sovereign and corporate credit look pretty stable at relatively benign levels.
Johnny, can you talk a little bit about the main risk scenarios you and your team are watching with respect to emerging markets next year?
So when we think about the main risk scenarios for emerging markets, they don't look like they're going to come necessarily from EM itself, but more the global, really the US environment. Maybe one smaller and more likely, the other one bigger and less likely. So let's look at the more likely first. And those are risks that come from the global interest rate environment. So if growth, inflation are going to be higher, rates globally and in emerging markets may be higher. And given we are at the end of these rate cutting cycles in EM, they can't be as much of a counterbalance to that. From the investors, actually, we spent the last few weeks talking to, their twist on this is actually a scenario where they worry that the Fed is too dovish in the face of better data, and actually the long end of the US rates curve becomes a bit de-anchored and more volatile. Now, that would probably be positive for emerging markets to start a weaker dollar versus EM currencies. But if we're going into an environment of high and volatile US rates, then it's unlikely to be good for EM bonds generally. Obviously, that's not the base case. Maybe the bigger risk would be the end to this risk-on environment, which has been led by US equities. Some rethink of AI capex or earnings, big fall in equities, takes down credit markets, maybe draws an end to this growth cycle overall. Again, not the base case for the equity team, but I think if we're thinking about some kind of global recession, that won't favor emerging market credit spreads or high-yielding local bonds, but maybe lower-yielding FX and rates might outperform in that environment.
Going deeper, are there any regional markets you'll be keeping a close eye on?
The idiosyncratic risks fall partly along regional lines, but some actually cut across. The first one is about transformative elections. So these are elections where you have very different candidates on offer, which may give a very different outlook for the countries. Chile just concluded on the weekend. We have swung from a left-wing to a right-wing president. We have transformative, potentially, elections in Colombia, Peru, Brazil in Latin America, Hungary and Israel in EMEA EM are all going to be very closely watched and be opportunities within markets. I think the second would be around what we call distressed opportunities. These are countries which are in default at the moment and may come out of that. The two big ones that investors are looking at are Venezuela and Lebanon. We're not sure they will exit default next year, but certainly they are going to be closely followed as opportunities. Frontier markets, what we call frontier markets in general, particularly in local markets, places like Egypt, Nigeria, Kazakhstan, maybe we'd put Argentina in that bucket as well, also been a great source of returns. They are naturally have uncertainty around them. So I think we're going to be keeping a close eye on those as well. And finally, maybe in more macro, is the Asian exporters. Probably put China in that bucket as well. Tech exporters, Taiwan, Korea, Malaysia, Singapore had pretty good economic performance this year. They have lagged in currency terms. So I think investors are going to be watching as well to see if either of those paths will shift.
Fantastic. Thanks for that, Johnny.
Thanks for having me.
And now we're going to turn to commodities. Joining us is Natasha Kaneva, our global head of commodities research. Natasha, thanks so much for joining.
Thank you for having me.
Let's start with oil. How are imbalances in the oil market shaping your price forecasts for 2026?
Yes, thank you, Sam. Well, first of all, the first message is that we maintain a bearish outlook since pretty much mid-2023. So if you take a look, oil prices averaged about $68 this year, down from $80 in 2024, and we believe there is another step down in 2026. Our price forecast is about $58. Our message to the market has remained largely consistent since mid-2023. While oil demand is strong, supply simply too abundant, expanding at 3 times the rate of demand in both 2025 and 2026 before moderating slightly in 2027. So there are 2 main sources of non-OPEC supply that we focus on. Number one is the global offshore sector. Once it was considered cyclical, cost-intensive, this sector has now transformed into a dependable long-term driver of non-OPEC oil production. Very important, it's positioned at the very low end of the cost curve. What it means is it's price inelastic, regardless of what the price does. This is the supply that will continue delivering. And the second one is because all the deep water platforms have been already sanctioned and delivered all the way through 2029, the sector offers exceptional visibility on new offshore barrels, making future completions highly assured. The second sector we're watching very closely is the global shale. We introduced this term in this outlook. Previously, it was just the U.S. shale. After the election, midterm election win in Argentina, we're talking about global shale. We advise the clients to pay attention to that sector as well. It's a large scale. It's relatively low cost as well, with a lot of volumes of supply coming there. So as a result, global inventories will be building. They increased by about 1.5 million barrels per day this year. Further builds in 2026 and to 2027. Without intervention, the surplus will climb even further, putting downward pressure on the prices. However, we believe that this magnitude of market imbalances is unlikely to fully materialize in practice, with adjustments expected on both demand side and supply side. But, the greatest burden of rebalancing will almost certainly fall on the supply side. So hence, we keep our price forecast for 2026 unchanged, 58. We introduced a 27 price forecast of about $57 per Brent.
Let's turn to precious metals. In 2025, gold was a hot topic. Do you see gold prices rising even further next year?
Yes, Sam, definitely. So this is a bullish recommendation that we maintain for a 4th year in a row. So as you remember, the first time we advised our clients to buy gold was in November 2022. For the 4th year, this is our top recommendation with further price acceleration. Our price target is $5,000 by the end of 2026. So supply remains relatively inelastic, which means that supply is not reacting to the prices, despite prices more than doubling since 2022. At the same time, the major sources of demand, in our view, will continue delivering into 2026 and 2027. Big focus remains on the central bank purchases. We do believe that they will maintain their buying patterns into 2026 and to 2027, albeit at lower volumes at what they averaged over the previous 3 years. On top of this, amid a combination of expected or further expected Fed cuts into early 2026, broader investor anxiety spanning U.S. debt sustainability, Fed independence, continued global financial easing, we do believe that we see there is a room for further robust growth in investor demand for gold too, particularly as we expect gold ownership to continue expanding into 2026 and 2027. So again, the price target for next year is $5,000 per ounce.
And lastly, what's the story for agricultural markets? Are there any signs of supply-side stress?
Yes, so the expected returns from the agricultural commodities are expected to be mixed. So, for example, we remain bullish on corn and wheat. We see greater upside in ICE number 2 cotton and ICE number 11 sugar, but we retain a more bearish outlook on soybeans. Interestingly, currently we see no clear signs of shortages or supply side stress in any of the agricultural commodities except in the livestock sector and to some extent cocoa markets. However, our projections indicate that global agricultural availability will remain near multi-year lows in the 2026-27 harvesting season, also in 2027-28, declining further from already low levels currently. We expect this tightening availability, driven by low producer margins, to heighten sensitivity and price volatility in response to supply-side shocks.
Natasha, thanks for your time and insights.
Thank you for having me.
And to round out today's episode, we'll hear from Fabio Bassi, head of cross-asset research. Fabio, thanks so much for taking the time to join us.
Hi, Sam. Thanks for having me.
What are some key themes you'll be focusing on in 2026 from a cross-asset perspective?
As we wrote in our outlook, we believe that 2026 will be driven by three powerful forces: uneven monetary policy, the unstoppable AI supercycle, and the deepening polarization across market and economies. First, on monetary policy, we are approaching the end of the rate normalization journey across developed market. The Fed is likely to deliver some selective insurance cut, while only the Bank of England is set for additional easing. But it's not, as I said, a one-size-fits-all story. Central banks are moving at different speed, and that divergence is going to create opportunity and risk across asset classes. Second, the AI supercycle is the real game changer. We are seeing a record level of capex and rapid earning growth, especially in the US equity market. AI isn't just a tech story anymore. It's spreading into banks, healthcare, logistics, and utilities. For investors, this is the anchor theme driving our bullish outlook on US stocks. Third, polarization is intensifying. In equity, there is a clear split between the AI-driven winners and the rest of the equity market. In the economy, strong capex stand in contrast to weaker labor demand and consumer spending. And also across households, the divide between high and low income is widening, creating a classic K-shaped recovery. How these polarizations are going to evolve is going to be critical for macro trends and market performance in 2026. What is the big macro takeaway here? Fiscal and monetary easing, combined with less policy uncertainty in the US, are going to boost business sentiment and help closing the gap between strong growth and the still soft labor market. But this resilience also means that inflation is going to be sticky. Tariff will keep some pressure on prices, and while AI productivity gain and lower energy cost will help, they're not going to be enough to offset it.
Now let's talk about different scenarios. What are some positive scenarios for risk assets that could play out next year?
Looking ahead, we believe there are several positive tailwinds that could supercharge risk asset in 2026. First, clearly, if the AI theme broadens even further, we could see a wave of investment as government and companies are racing to avoid being left behind. This is what we call the FOBO, the fear of being obsolete effect. This could drive capex, innovation, and ultimately also earning growth across sector. Second, there is a possibility of what we call immaculate disinflation. If inflation falls faster than expected, the Fed could deliver more easing, bringing rates down to or even below the terminal level that it currently priced in. That would be a major boost for equity, credit, and other risk assets. Third, global fiscal easing and a rollback of tariff could add even more fuel to the fire. For example, if the Supreme Court rules against a broad IEEPA tariff and the administration doesn't replace them with a universal 15% tariff, that could open the door to stronger global trade and growth. In Europe, the big upside comes from German fiscal expansion. And while a geopolitical solution to the Russian-Ukraine conflict remains a wild card, even a ceasefire could have a meaningful impact on energy prices and sentiment. That said, we are realistic about the challenges. Getting a full peace agreement with a strong security guarantee is a high bar.
Conversely, what are the main negative risks we should watch out for?
Well, on the flip side, there are some real risks that could derail our positive outlook. The biggest near-term risk is a genuine macro slowdown. If labor demand stays weak and payroll disappoint, we could see a recessionary dynamic taking hold. It's not our base case, but we are still assigning about 35% probability to this scenario. So that definitely remains on our radar screen. Sticky inflation is another key risk. If price pressure persists and the Fed pivots away from its current stance, removing its asymmetric bias and opening the door to rate hikes or tighter liquidity, that could tighten financial conditions quite quickly. This is going to put pressure on risky assets, especially those that have benefited from easy monetary policy. Finally, we have to talk about AI skepticism. With valuation running hot and a lot of hype in the market, there is a risk that investors start to question the sustainability of the AI boom. While we believe that fundamental, capex, sales growth, earnings, and buybacks will support the AI sector, we can't rule out episodes of volatility or temporary retracement. In short, 2026 will be a year where investors need to stay agile. Keep an eye on both the upside and the downside, and be ready to pivot as the data and the headline evolves.
Fabio, thanks for sharing the cross-asset view.
Great chatting with you.
All right, that wraps up our 2026 Outlook episode here on Making Sense. We hope you found the insights from our analysts helpful and insightful, and we want to thank you for tuning in. For more market insights, be sure to visit jpmorgan.com/research.
Thanks for listening to Research Recap. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, and YouTube. This communication is provided for information purposes only. For more information, including important disclosures, please visit www.jpmorgan.com/research/disclosures. Copyright 2025 JP Morgan Chase & Company. All rights reserved.